Now, suppose if you want to find out a value of a company or any asset, we need to find out what are the cash flows a company is generating. Now, for example, let's take an example. Suppose you're owning an asset, a property. Suppose it is giving you a rent of a lakh rupees per annum, and it is expected to grow by, say, 5% or 10% per annum. That means you're going to get 1 lakh rupees in the first year, and in the second year, you're going to get 1 lakh 10,000, and similarly, in the third year, say 1 lakh 21,000 if it is growing at 10%. You will keep doing it, that calculation, and that is what is the cash inflow which you're getting by owning that asset. Now, now, in the meantime, suppose if somebody comes to you and offers a price to you because he wants to buy this asset from you, and then in that case, how much you would actually like to receive the money from him, it will be basically nothing but the present value of all the cash flows which will be earning by owning that asset. Because if you get that money from him or the value of an asset, you can put it in a investment and generate a similar returns. So you would be happy to receive all the money today, what you're going to get from owning that asset. Now, all those cash flows which you're going to get are called the free cash flows for you. And to determine the value of that asset, what you are trying to do is to calculate the present value of those cash flows by discounting at an appropriate rate. And you arrive at, and it all depends upon the riskiness of that asset. So your discount rate will be either more or less, will depend upon what kind of an asset that is. If you talk about in a company, what kind of a company it is. Is it a consumer staple company or a consumer discretionary company? If it is going to be a consumer discretionary company, that means it is manufacturing products which are which consumers use their discretion to buy. In good times, they would like to buy the products of that company. For example, a company which is a real estate company. If you want to buy a house, so you will use your discretion. When you're comfortable that you have a good future and you will be earning a lot of money, and you can always pay that amount to acquire that asset. Or for example, automobile companies. So if you want to buy a car, there also you use your discretion. And in good times, you will like to buy a car when the interest rates are down. Suppose you're going to buy it on a loan. So you would like to look at the rate which is offered by the banks for giving you a loan. Now, or for example, a hotel industry, or a travel industry. So all those industries are basically those industries where we use our discretion, whether to stay in a hotel, go for travel, buy a car, or own a house. But on the other side, there are companies which are called consumer staple companies. For example, those companies like FMCG companies or medicine companies or pharma companies, where you buy those products of those companies. There you don't use your discretion. Even whether the economic situation is good or bad, you're going to buy the basic necessities of your life, which has been distributed by these companies. So these companies will have a lower discount rate, and you are going to, those companies will be highly valued because you're going to discount the cash flows of those companies, which they're going to generate at a lower discount rate. Whereas the companies which are, in discretionary industry, you're going to use a higher, discount rate because there is a risk involved here, and the discount rate will go up, or the cost of capital of these companies will be much higher than compared to the cost of capital of the companies which are in consumer staples. So that's why when we project the cash flows, how much cash these companies are going to generate, the free cash flows, what we call them, and then we discount those cash flows using the cost of capital of that company. I mean, if the company is more riskier, the cost of capital, both in terms of the equity as well as the loan what the company takes. So it's usually basically we use weighted average cost of capital as a discount rate to calculate the value of a firm. And alternatively, you can even calculate how much cash the company is going to generate for the equity shareholders. what is the free cash flows the company is generating, and there you discount those cash flows using the cost of equity. Now, as I told you, the cost of equity will vary depending upon which company it is. The riskier the company, higher would be the cost of capital. Less risky the company, which means then the lower would be the cost of the capital or cost of equity. So basically, the cost of capital or cost of equity depends upon the riskiness of the cash flows which the companies are going to generate. If those cash flows are uneven in nature, because the cyclical companies which are more riskier will do very well in good times, but they won't be doing that good in the time when the economy is on a down cycle. So certain companies are cyclical in nature, so they have good times and they have times when those companies don't do well. So their cash flows are uneven and risky in nature. Whereas the FMCG companies, which are consumer staple companies, they generate a steady cash flow throughout the life of their business, and whereby their discounting rate is much lower. Their total weighted average cost of capital is much lower than the weighted average cost of capital of a consumer discretionary company or a discretionary company. So if we have to find out the value of a company, then first, kind of a job would be to forecast their future the profits of the company, future sales of the company. So we use a method which is called discounted cash flow technique, where we try to find out how much that company is going to, what is the profit the company is going to make in next 5 to 10 years, and those profits we convert them into cash flows, because the profits which are earned are in accrual in nature, and we need to convert them into cash flows, free cash flows, so that we can discount using an appropriate discount rate.